The most important thing to know when you're trying to achieve any goal is to realize where you currently stand. This is just as true if your goal is financial independence. Imagine trying to give someone directions to your house if you don't know where they are. That's why creating a financial inventory is so important, and that's what we're going to talk about in this video. Hi, this is Dave from the Two Poor Millionaires, and in this video, I'm going to show you how to create a financial inventory, as well as walk you through a tool we've created that you can use totally free to help you with this. But first, I'm going to go over exactly what I mean when I say financial inventory. Some people think a financial inventory is the same thing as a budget, but they're actually a little different. When you create a budget, you're actually setting limits on your future spending, but a financial inventory looks at your current or past spending. It really is like taking a deep look into your current financial habits, where your money is coming from, and where it's going. That's why we call it a financial inventory. You really are taking an inventory of your current financial standing. Once you have a financial inventory in place, you can use it to create a budget and figure out areas in your life where you can save. If you've seen any of our other videos, you'll know that we're big fans of cutting out as many unnecessary expenses from your life as possible and putting all of your leftover money into smart investments. Well, proper budgeting, which requires an understanding of your current financial situation, is how you can maximize your savings and reach financial independence in the least amount of time. Now, before we actually get started, you need to get some things together. First and foremost is probably going to be bank statements and credit card statements for at least 6 months. If you also make cash purchases, you should get together receipts for 6 months as well. If you don't have those receipts, it's okay, but it's going to take you longer since you'll have to adjust your numbers over the next few months. You should get together pay stubs and any other documents that will help you remember exactly how much money you received and spent. All right, let's get to the tool I promised you. Here's the worksheet we created in order to help you with your financial inventory. There's a link to it in the description. The first thing you're going to have to do is make a copy. You won't have the ability to enter any information here as it is, so click on File up here and then click on Make a Copy. Now you might not see that menu. It might look more like this. So if that's the case, then just click on this little down arrow that's up here in the right, and then you can click on File and Make a Copy. I'm going to hide this for now just so I have more space on the screen. Now there's quite a bit of information on this first screen with lots of instructions. I'm not going to read them all to you because you can read them on your own, and really I'm going to end up mentioning all of this within the video anyway, but it's here so that you can refer back to it later if you need to. The financial inventory basically consists of two parts. You have income and expenses, and each of those are further broken down into consistent or variable. I'll start with a consistent income. We'll go to that tab down here at the bottom, and we'll get to this page. This is where you're going to enter any of your income that is the same over and over again. For example, if you're paid a base plus commission, the base, which is the same in every paycheck, is considered consistent and will go on this page. The commission part is probably variable and should go on to the next page that we'll talk about later. In all of our spreadsheets, the areas where you should enter information will have a yellow background, such as this here. So this is where you should enter all of your information. You'll get an error if you try to enter information in any of the cells that don't have a yellow background. For your salary information, you should probably enter all of your data after deductions have been taken out, such as taxes, health insurance, retirement fund contributions, etc. In other words, you'll enter your take-home pay or your net income. In that case, you won't enter any of these items in the expenses area later. Alternatively, if you do want to track all of your payroll deductions in the expenses tab, you can certainly do so, but then you'd need to put your gross income here on the income tab. Now let's look back at the example I mentioned earlier, where someone might be paid a base rate plus commission. In this case, you'll have payroll deductions taken out based on the total amount, so it might be hard to figure out how much to enter for your consistent income after deductions versus your variable income after deductions. So in this case, just enter the whole amount on the variable income tag that we'll talk about soon. So you've determined what your consistent income sources are. Let's start entering them here. In the description column, you just enter a short description. It might be something like my salary, or your spouse's salary. You'll probably want to use actual names here though. So I'm just going to put my salary here, just for an example. Now you'll need to enter the amount of your salary, but under the appropriate frequency column. For example, if you're paid $1,000 weekly, you might put 1,000 under weekly. Or maybe you're paid $4,000 a month. In that case, you would enter 4,000 under monthly. We also have columns for bi-weekly, which is every 2 weeks. Semi-monthly, which is 2 times a month. Quarterly, which is every 3 months. Semi-annually, which is every 6 months or twice a year. Annually, and then biannually, which is every 2 years. It's unlikely that you're going to be paid biannually, but it's here just in case. Another feature of this worksheet is that you can enter amounts in multiple columns. For example, let's say someone makes $1,000 per month, but they get an annual bonus equal to 1 month's pay. Then they'd put 1,000 in the monthly salary, and then they would enter 1,000 under annually for the extra bonus. The calculator will automatically distribute all of the income over 12 months and compute the average monthly income in this final column over here. The last thing I want to mention on this tab is the section here labeled Other Frequency. This probably won't be necessary for most people, but it's here just in case. Let's say that you're paid at some weird frequency like every 4 weeks. That doesn't work in any of the other columns that we have listed, so we'll enter it in the other frequencies. So if we make $3,500 every 4 weeks, we'd enter $3,500 under the amount. We would enter 4 after every, and then select weeks from the column. So basically this now reads $3,500 every 4 weeks. So you're basically filling in the blanks in the sentence. And just like before, this is averaged out and entered into the average monthly income here in the last column. We'll now move over to the variable income. This is where you're going to enter all of your other income. This tab is simpler to explain but requires a bit more work on your part. First, you'll enter how many months you're using for your time frame. As I mentioned before, we recommend 6 months, so that's the default. The worksheet will automatically compute the date 6 months ago and show you the first date that you should start entering data. In this case, it's July 14th of 2023. When entering your amounts, you have 2 choices, but in each case you'll enter a date, a description, and an amount in the respective columns. Your first option is to look at all of your pay stubs over the past 6 months and enter each one of them line by line. So if you're paid every 2 weeks, you'll probably have 26 entries here, 1 for each paycheck in the past 6 months. The second option is to enter just the total amount of all of your paychecks for the entire 6-month period and enter that total on a single line. In that case, you don't need to enter a date. In fact, the date really isn't used in any calculations. It's just here to keep you organized when you're entering your information. Now, let's move on to consistent expenses. You'll see this tab looks very similar to the consistent income, and that's because it's laid out in the exact same way. The only difference here is that you're going to enter expenses instead of income. Like before, consistent means any expenses that are the same every month. Good examples are rent or your mortgage, your cell phone bill, your cable bill, streaming services, etc. These are the same every month. Things such as your electricity bill, your groceries, eating out, those are variable and are going to go into the variable expenses later. Earlier I mentioned that you should gather your bank statements and credit card bills. I should make it clear that you shouldn't enter your credit card payments here, but instead you should enter the things you paid for with your credit card. In other words, don't enter any money that you sent to the credit card company to pay down your balance, just the things that you bought with your credit card. As before, you'll enter a description in the description column and then the amount under the correct frequency column. You can use the other frequency section just as you did on the consistent income tab. Just fill in the blanks. Blank dollars every blank blank. So for example, $30 every 10 days. One important thing I'd like to note here is that since we're using a 6-month time frame, It's easy to forget about very infrequent payments, things like vehicle registration, HOA dues, etc. In order to refresh your memory on these, I recommend you go back to your bank statements for a longer period of time just to jog your memory. Look back for a full year or maybe even 15 months. That should remind you of those infrequent expenses. Some people have asked how to fill in the description tab. Should you enter every purchase separately or list them all individually? Well, this really is up to you. Remember, this is your financial inventory, and the goal is to provide you with insights. If you and a spouse each have a vehicle that you pay insurance on, you might want to combine them into a single car insurance row or list them separately. However, if you have separate car payments, you're both paying off a car, you might want to list those separately. The only thing that's going to change is how these things are reported on our final summary tab. My recommendation would be to combine anything into a single row if they're relatively the same amount. But if one is drastically more than the other, separate them so that you can see that difference and perhaps reduce the more expensive one. Moving on to the variable expenses tab, it really looks similar to the variable income tab. Just enter your time frame again, which we default to 6 months. Then start entering all of your expenses. Again, you can enter every purchase individually, or you can sum up the expenses of a certain category over the entire 6-month period and then enter them all in one line. This is also where you're probably going to enter your payroll deductions if you haven't already accounted for them in the income tab. Remember, the goal is to make sure you've accounted for every source of income and every expense exactly once. Don't double up on anything. One last note here about categories. Knowing all of the category descriptions up front is probably going to be impossible. So I'd recommend that you just start out with your first expense. Let's say you visited the grocery store and enter it in the first line. So we'll say groceries, and you spent, say, $60. Now your next item might be a cell phone bill for $30. Look at all of your existing categories, of which case there's only one, to see if it fits. Well, cell phone bill is not groceries, so I'm going to create a new category for it. So we'll say cell phone, and we might say $35. Now, let's say you made another trip to the grocery store. Well, I do have groceries listed here, so I'm going to reuse that same category and put in the new number here. So this represents 2 trips to the grocery store and 1 phone bill. It's very important that the description that we use here matches exactly, because it's these descriptions that we summarize when we go into the summary column at the end. Speaking of that, let's move on to our very final tab. On the summary tab, we're shown our bottom line. This is how much money you have left after paying all of your bills. If it's positive, then we can start saving. If it's not, then you're living beyond your means and should really figure out how to increase your income or reduce your spending. I've entered some fake information here on the other tabs just to make this summary a bit more complete. You can see here that the bottom line is $998.75. This means that I can set that amount aside each month in order to invest. If this were negative, I'd have some serious soul searching to do. You can also see here that all of our income and expenses have been copied over and they've been sorted in descending order by amount. Because of that, I can see our biggest expenses as groceries, followed by healthcare, and then the HOA fees. We might be able to cut some things out of our grocery trips in order to invest some more, but we might not be able to cut out healthcare costs as easily, and we probably don't have much control over the HOA. There we have it. I hope this video and worksheet that we've created have been helpful. Even more than that though, I hope that this content will inspire you to create your own financial inventory. It really is the first step, and a step that you should perform regularly, on your journey to financial independence. Here's wishing you financial success.